We haven't seen a lot of activity in markets this week, but what we have seen is this ongoing demand for currencies into dips against the US dollar. We wonder if this is the start to something bigger, with the US dollar at risk for a more pronounced decline after putting in some impressive gains over the past several months. We've already highlighted the exceptionally low volatility in the euro, which suggests we could soon see a pickup in volatility. And pickups in volatility often coincide with trend reversals. If we look at the euro, data has been softer, and there continues to be downbeat talk out from ECB officials, with more coming on Tuesday after reports of a significant minority of ECB policymakers questioning the central bank's growth assessment for the second half of the year. And yet, the euro has easily absorbed the selling from this news and has been bid back up. Currencies have broadly followed the euro's lead, and it seems we have reached an inflection point where perhaps all of that dovishness has been priced into the euro, while there continues to be room for more adjustment on the Fed side, and there continues to be risk for US dollar selling on the back of soft dollar US administration trade policy. Even on the UK front, with uncertainty around Brexit still there, the pound has done a good job holding up. Again, it appears to be a case of what is priced in and what is not. The pound is a lot more comfortable now that worst-case Brexit fears have faded away, while those US dollar risks are still there. And we've seen similar patterns of currencies holding up against the US dollar despite developments that haven't been supportive. Look at the more dovish-leaning RBA minutes this week, and look at another round of soft Kiwi data by way of a drop-off in the GDT auction results and this subdued inflation reading that we just saw earlier today. While we would concede that there may be US dollar demand that could come from another liquidation in risk assets given the political backdrop and outlook for global trade, we don't believe the US dollar will be wanting to absorb as much safe haven flow as it has traditionally absorbed, and certainly not against the other major currencies. Interestingly, with respect to global risk dynamics and the possibility for this equity market surge in 2019 to fizzle out as the consequences of unprecedented periods of monetary policy accommodation finally work through the system, we look to the Swiss franc as a currency that might not be too excited about all of this, with the SNB battling hard to keep the franc from appreciating, even through what should have been an unsupportive period of time for the Swiss franc. We highlight this fact today with the franc having weakened quite a bit against the euro after recently rallying to fresh multi-month highs against the single currency. The euro-Swiss rate has pushed back to important resistance into the 114 area and closer to 115, all while it looks like risk appetite could once again be reducing in a big way, which would argue for Swiss franc appreciation and major downside pressure on the euro-Swiss rate back towards the 112 area. But overall, the big question here is the state of the US dollar and analyzing this latest price action, which does suggest that despite any bullish implications from various developments that show room for what could be additional dollar upside, there's been a lot in the price action that shows that this might not be the case, and we could soon see a broader secular decline in the US dollar. That's all for now.